Welcome back in YouTube. As we can see, PayPal is absolutely selling off, and we're going to dig into this one as it's basically falling right into a range I was looking at. Between $51 and $64 is about what I was looking at for PayPal, and this is starting to hit a multi-year low. So let's get into it. First thing I want to do is just point out the chart here in PayPal. This was what we consider a multiple expansion story here, especially when we're talking about the pandemic. The fintech field was just getting a little overvalued, and I decided to stay away from this one. Another one that got involved with this would obviously be Square. A lot of these payment process companies were kind of oligopolies, and they didn't have a ton of competition, but now you have multiple companies and industries entering this field, forcing some margin compression here, in my opinion, especially when we start talking about Apple Pay, right? We rewind a few years ago, and it was basically PayPal's was the only name, the only company in the field. And so I'm starting to value this as more of a value play rather than a multiple expansion play. And it's definitely getting at interesting levels. And we're going to talk about some metrics we need to be looking at for PayPal. So when we look at top line revenue growth, obviously they're still growing their revenue. The problem was margin expansion. Now PayPal was starting to talk about margin expansion going forward. And now with the competition picking up and looking over their financial report, it doesn't seem like this is going to be a margin story. And so when I was digging through the report, we can see that they are expanding margins, and that is not what the problem is. The problem is take a look at what happened with their tax rate. So they went up 3.22 basis points on their operating margins, but their tax rate jumped nearly 7%. Basically washing out from those margins and taking away from those margins, leaving a less than impressive net income when we look at top line revenue growth of coming in at $7 billion versus 6.4, roughly $557 million of top line revenue growth. But when we bring that down to net income, it's only a $290 million net income growth. And so this is where I think the fear is coming in, as the outlook as far as competition goes is going to be a little bit more stringent. We're going to see a lot more competition here, and when competition picks up, that usually means margins get impacted. It also means that growth is going to get impacted because there's more options for people to choose as far as payment processes. I definitely think they're going to still have a massive footprint in this arena, but it's fear of the market here, and we're starting to see that being priced into the stock. And so it's all getting priced in at once, and this is going to lend the opportunity, if you can see forward, if you believe in a company, this could be an opportunity to buy it. Now, this is a company that does $4 to $5 billion of free cash flow and has roughly a $75 billion market cap. So we divide that by, call it 4.5, just to be a little safe here. You're basically paying 16 times free cash flow to market cap, which is not super cheap, but it's not that expensive either. It's kind of in the middle here. So we're starting to find a middle ground when we factor in that the run up during the pandemic was a little extraordinary, and we're starting to find some value here with a company like PayPal. And just to give you an idea, anything under 10 is usually considered fairly cheap, especially if there's growth opportunity within a stock. And the one thing I want to say is nothing really looks broken with their business model. There's growth everywhere: top line growth, user growth, payment transaction growth. So nothing too alarming when I look at their business. There's nothing that looks like it's deteriorating or anything of that nature. And they're repurchasing stock here. 19 million shares were repurchased during Q1 of 2023. So they're returning equity to shareholders, returning $4.1 billion to stockholders. So you really like to see that. This is the most efficient way to return equity to shareholders. And when it dips 13% and starting to hit a multi-year low, I definitely think this is something you want to take a look at. And they are raising EPS guidance to reflect Q1 2023 momentum. This is also due to the fact that they are repurchasing shares, and that's basically rewarding shareholders. So when they guide for Q2 2023, they're basically guiding flat here between 115 to 117 non-GAAP EPS, which is roughly what they did this quarter. So they're basically guiding for the same growth. So they're basically guiding for the same EPS for Q2 as well. Now, they will be growing GAAP They will be growing GAAP EPS, which is better. You'd like to see that. They did 70 cents this quarter, and they're expected to do 81 to 83 cents next quarter. And so when they're talking about the 24 to 26% growth, they're really reflecting GAAP EPS growth, not non-GAAP EPS, because the non-GAAP did come in line with basically what they're guiding for next quarter. And they're expecting to repurchase about $4 billion worth of shares. Currently, the stock is trading right around $66 a share, and they're going to do about $117 for the next couple quarters. We multiply that by 4. We get $4.68 for the full year guidance, basically saying that they're not even going to grow, but as we can see, they're buying back shares. And I think this is a base case situation here. I tend to think that the business doesn't look like it's deteriorating. It's actually growing slightly, and they're buying back stock. So everything looks to me like this should outperform $4.68, but just to kind of play it safe here, I'm going to use a flat EPS. Currently trading at $66 a share. We divide that by 4.68, and you get basically a forward PE of roughly 14. And so let's run the GAAP numbers now. They're basically going to do 70 cents this quarter, and they're going to average right around 82 cents the next couple quarters. So we'll do 82 times 3 for the next 3 quarters. Gives us 246 plus the 70 cents for the current quarter. Gives us 316, trading at 66 a share, divided by 3.16, gives us roughly a 20 to 21 forward PE ratio. So overall, I would say that the stock is looking pretty interesting, which I do believe is a pretty solid deal for PayPal here. Now, I do think there's going to be selling pressure. It's going to get downgraded. We're probably going to see it hit my price target right around that $55 to $60 range, and that's where I think it gets really, really interesting for PayPal. You're basically owning a value stock at that point. They're returning capital. I think they have a big enough footprint where they're not going to go anywhere. And then when you measure it on every metric, whether you want to talk about free cash flow, you want to talk about the forward PE and the trailing 12-month, I think you're getting a pretty good bargain at these levels. So I actually do think PayPal is becoming pretty interesting at these levels. And this one I just wanted to touch on, guys, really quick, as this was a shout out. And I know with the recent sell-off, people are probably questioning what's going on. And I think there's a multiple questions here. Number one is going to be the competition. Is competition going to deteriorate this business model going forward? And number two is going to be, are they going to be able to keep expanding margins? As we saw, the street was looking for better margins going forward, and it looks like the tax rate is what's kind of holding that back and actually ruining what could be much stronger margins. So as always, guys, appreciate your time. That was my quick dive into PayPal. Very interesting stock at these levels. I definitely like it once we get closer to that basically $51 to $60 range, which it's knocking on that door. So as always, guys, appreciate your time, and we will see you in the next one. Peace.